You know this. I know this. We're in a new bull market.
We
Whoa.
are,
So yeah,
technically
it's
speaking.
technically speaking, we've been navigating a pretty rough stretch of stock markets, but the tide is now turning, and who better to get us kicked off for this new bull market than the one and only Zach Scheit. Zach, how are you, man? What are we looking at today?
I'm doing well. I'm doing well. Well, we've got more stuff going on in the market, and yes, that's the big news of the week or so. Over the past week, the S&P 500 did in fact cross that magical line, up 20% from its bear market low, and that triggers what we technically call a new bull market. And I say that tongue in cheek because, there's nothing magical about a 20% line. It could have been 19%, it could have been 21%. What's the difference? But the real difference is, for us as investors, this whole psychology of we've got a new bull market. I'm sure you guys saw the headlines that hit newspapers and news services, and the media is talking about it. And when you see something like this happen, what it can do is it can trigger a fear of missing out, or FOMO, for other investors. And this is true both for individual investors and also for professional investors too. In fact, sometimes we think about the individual investors as being not as sophisticated, and the professional investors as being more, staid and logical and so forth. But that's not always the case. When I was a hedge fund manager, we had to look at our numbers quarterly, and we had to make sure that we were not just doing well for our clients, but that we were keeping up with the market, that we were doing better than our competitors. And so when you end up with a new bull market, often you wind up with professionals who may not be keeping up with this bull market. And all of a sudden, the spotlight is shown on them, and their investors and their bosses are saying, why didn't you keep up? Why are you not fully invested? Why are you not invested in the stocks that are moving higher quicker? And so this new bull market can actually cause a lot of buying pressure, as this fear of missing out hits both the individual investors and the professional investors, because for them, they can actually lose their job if they're not keeping up with this new bull market. So it's an important time, sentiment wise, for the market. Another thing to keep in mind with sentiment is that we have gone through this period where investors have been uncharacteristically bearish for a very long time. So for 18 to 24 months, investors have been, there's a survey that goes out every single week, and investors are asked, if you're bearish, if you're bullish, what your expectations are. And that survey has come in negative week after week after week after week to historic levels. And now, just now, we're starting to see that survey switch higher, where investors are starting to feel bullish. Now, this could be a big driver of more buying orders coming into the market, driving stocks higher, simply because it's been low for so long. These investors have taken cash out of the market, and they've had good places to put it, right? Because interest rates have moved higher, there's been an incentive for people to pull money out of the stock market, for them to put it in bonds, in CDs, in money market funds. And so there is a lot of cash that's now available because of that negative sentiment to come back into the market. And this can help to drive stocks higher. So there's a lot of cash on the sidelines. And that's like having dry powder ready to cause an explosion, a good kind of explosion in the market, and why I think we could see some additional gains in the market very quickly here over the next few weeks. Another thing that's very positive about this market is the breadth. And by breadth, I mean the number of stocks that are actually participating. So in the first 4 months, 5 months of the year, we saw the major mega cap tech stocks really driving the market higher. You've seen NVDA, the semiconductor stock that's rallied just astronomically, and it actually had the biggest one-day gain in market cap that we've ever seen after they announced earnings. We see Microsoft trading higher. Apple is hitting a new all-time high, and that's the largest stock in the market. These big tech stocks have been driving the market higher. And that has been a little bit unhealthy because a lot of the other smaller stocks just haven't been keeping up. But now we're seeing a bit of a rotation just now in the month of June. So it's very fresh, it's very new, and it has some staying potential, where we're seeing small cap stocks in other areas of the market, industrials, retail stocks, these different areas of the market are now catching up and trading higher. And that's a very healthy sign. And also, I love it because it gives us more opportunities to make money. We don't have to be just in these handful of stocks that are driving higher. Now, the broad market is starting to move higher. Now, I will say that there is still plenty of concerns out there, and that's not necessarily a bad thing. We're still kind of on recession watch, right? There's a lot of economic indicators that are pointing to we may be able to avoid a recession, but we may still have that on the horizon. Bank risks are still in play, and as interest rates move higher, banks will have the same problems that they had earlier this spring when we saw Silicon Valley Bank and two other important banks in the system actually go under, and that had a lot to do with interest rates moving higher and their bond portfolios moving lower. So that's still a big risk. We've got geopolitical risks, China, Russia, in the Middle East. We've got plenty of things for investors to worry about just in terms of politics. And then, of course, we've got inflation, and we're going to talk about inflation in just a minute because we just got some very important information there. But inflation is something that could certainly cause more problems and more havoc in the overall economy. So those are things that we're worried about. But there's an old Wall Street saying that markets tend to climb a wall of worry. Markets tend to trade higher when investors have plenty of things to worry about. This really ties back to the sentiment thing. So when investors are worried, they keep cash on the sidelines or in money market funds or in bonds. But every time one of those worries is averted, we already had the debt crisis or the debt ceiling crisis. We averted that, right? And so that's one less thing for people to worry about. Every time you have one of those boxes that's sort of checked off, and investors don't have to worry about it, or even if it just looks a little bit more likely that maybe we're not going to go into recession this quarter, maybe we can push it back a little bit. Those worries that are taken off the table or that are subsided help to drive more investors into the market and drive stocks higher. So that's why you see markets tend to trade higher when that worry is present. So we've got plenty of things to worry about, but we've got a market that's trending higher. And this is actually a really good situation for investors.